Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we begin with significant changes to Canada's mortgage and down payment rules that have just come into effect. Announced by the federal government in September, these new regulations are expected to open up additional opportunities for potential home buyers, especially first-time buyers and those interested in newly constructed homes. One of the most notable changes is the increase in the price cap for mortgages insured against default, which has risen from $1 million to $1.5 million. This adjustment allows more people to qualify for mortgages with smaller down payments. Previously, buyers of homes priced over $1 million were required to put down at least 20%. Now, those purchasing homes up to $1.5 million can benefit from this change. Another key update is the extension of the amortization period for first-time home buyers with insured mortgages, as well as buyers of new builds. They are now eligible for a 30-year amortization period, compared to the previous 25-year limit. This change provides borrowers with more time to pay down their mortgage balance, potentially increasing their buying power. Additionally, homeowners with insured mortgages now have the option to refinance their properties up to $2 million to create additional dwelling units or laneway homes. This could encourage some homeowners to contribute to increasing housing density in urban areas. While these changes are designed to help more Canadians enter the housing market, some experts have raised concerns about potential home price inflation. John Pasalis, president of the brokerage Realosophy, has commented that increasing household borrowing power might drive home prices higher, making this a short-term policy fix rather than a long-term solution for affordability. On the flip side, this move is seen as beneficial for people in large urban centers like Toronto, where home prices are significantly higher than in other parts of the country. The median sale price for a single detached home in Toronto is currently around $1.23 million, according to the Canadian Real Estate Board. For condo units, that figure is about $615,250. Local mortgage broker Mary Seltzis has shared optimism, suggesting that these changes will open up new opportunities for buyers. She notes that a longer mortgage term can mean more interest paid over time unless borrowers make extra payments or choose bi-weekly payments to reduce the overall interest cost. These adjustments to the mortgage rules reflect a significant shift in the Canadian real estate landscape, aiming to make homeownership more accessible while balancing the risks of increased borrowing. As always, it's advisable for potential buyers and homeowners to consult with a professional to understand how these changes might impact their personal financial situations. This week, Canadian mortgage rates are poised to climb, driven by a notable increase in government bond yields. Specifically, the Government of Canada 5-year bond yield has surged by 19 basis points over the last 3 days. This rise in bond yields is largely attributed to recent rate cuts, and while the 5-year fixed-rate mortgage has not yet reflected this increase, similar pressures have already pushed up other fixed-rate interest costs. This means that prospective home buyers should prepare for potential increases in mortgage rates. Meanwhile, the Bank of Montreal, one of Canada's Big Six banks, has highlighted that while rate cuts may offer some relief to existing mortgage borrowers, they are not likely to spur new buying activity. The bank pointed out that variable rate mortgage and home equity line of credit borrowers will benefit from the cuts. However, for new buyers, the advantage may be limited because they already have access to relatively cheaper, fixed-rate mortgages. This dynamic could change soon, though, with the rising bond yields. In another significant move, the Bank of Canada has implemented a supersized rate cut, driven by concerns over a slowing economy. The central bank pointed to a gross domestic product that fell short of expectations and cited policy decisions as contributing factors. A primary concern for the future is a potential slowdown in immigration, which has been a key driver of economic growth in recent years. While an increase in aggregate GDP has been observed, it primarily supports government borrowing unless adjusted for per capita measures. In the Greater Vancouver area, real estate sales have surged, showing a 40% increase for November compared to last year. This jump has contributed to firming prices in the region. However, it is important to note that inventory levels have also risen, reaching some of the highest figures seen for this month in the past decade. This dual increase in sales and inventory has created a balanced market environment, but it remains uncertain how long this trend will last as we move into the winter months. On the currency front, the Canadian dollar, also known as the loonie, is forecasted to remain weak against the United States dollar. While a weaker currency can attract foreign capital by making Canadian labor cheaper, it also raises the cost of living as many commodities are priced in United States dollars. This situation presents a calculated gamble that may have mixed results, particularly as the United States pursues policies to increase domestic employment and reduce reliance on foreign labor. Finally, in Toronto, the jobless population has reached 380,000, a level not seen since May 2021. This means nearly 1 in 10 workers in the Toronto Census metropolitan area is struggling to find employment. The high unemployment figures suggest that the region's economy is facing significant challenges, reminiscent of the economic conditions during the pandemic. Our final story today delves into the urban-rural mortgage divide, a growing trend that has seen more rural first-time home buyers opting for non-bank lenders over traditional banks. This shift is especially evident in Ontario, where data from the real estate intelligence platform, Terranet, highlights the changing preferences of first-time buyers over the past decade. At the start of the last decade, there was minimal difference between urban and rural buyers in terms of their choice of mortgage providers. About 65% of urban buyers and 62% of rural buyers opted for one of Canada's Big Five banks. However, this gap has since widened significantly. By 2023, only 48% of rural buyers were choosing a Big Five bank, though this figure rebounded slightly to 55% in the first half of 2024. Meanwhile, urban buyers have consistently leaned towards these major banks, with 71% doing so in the first half of this year. Financial industry experts suggest several factors might explain this divergence. In smaller communities, the availability of financial institutions, the approach of major banks to rural properties, and the competitive nature of monoline lenders in the insured mortgage space could all play a role. While the data from Terranet specifically focuses on Ontario, these factors are likely applicable across Canada. Despite aggressive competition among major banks to maintain their mortgage market shares in a sluggish housing market, non-bank lenders continue to attract rural buyers. Royal Bank of Canada's Chief Executive Officer, Dave McKay, described the market as ruthlessly competitive, with banks absorbing customers' demands for lower rates, which in turn affects their profit margins. While most Canadians still secure their mortgages through banks, Robert McLister, an interest rate analyst and mortgage strategist, notes that well-qualified borrowers tend to get better deals with a Big Five bank. However, rural buyers often require more flexible underwriting due to factors such as property location, down payment size, and debt service ratios. Credit unions and non-bank lenders are known for providing the flexibility that big banks might not offer, especially for rural properties that are harder to market. David McVeigh, a banking industry consultant, points out that rural properties present unique challenges in underwriting compared to urban properties due to their marketability. Rural homes often take longer to sell and have less demand, which makes banks more cautious. Credit unions, by contrast, are more familiar with local markets and are willing to take on more risk. Convenience is another factor influencing rural buyers' mortgage choices. Alex Leduc, founder of the online mortgage brokerage Perch, highlights that bank branches are typically less accessible in smaller communities, whereas credit unions are more prevalent. This familiarity and accessibility make credit unions an appealing option for first-time buyers in rural areas. Additionally, mortgage insurance plays a role in this divide. David Larocque, a Toronto-based mortgage broker, explains that monoline lenders can offer more aggressive rates on insured mortgages, making them more attractive to rural buyers who often purchase lower-priced properties that qualify for default-insured mortgage rates. As the urban-rural mortgage divide continues to evolve, it's important for buyers, whether in urban or rural settings, to consider all their options and seek professional advice to navigate the complexities of the mortgage market. Understanding the nuances of each lender type and what they offer can make a significant difference in finding the best mortgage solution for individual needs. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.